Welcome everyone to a new ATFX market report. My name is Gonzalo Canete, and in this case I'm gonna share with you the impressions we got after the last speech of Jerome Powell, President of Federal Reserve, and why this last word has changed the reality of the market in my eyes. We also have seen how after that conference markets are dropping, especially the US equity is dropping, and therefore the rest of the equities around the world are mainly follow the trend from the US market. What's the reason for this drop? How we can explain this reaction? Because in theory, it was a positive news. Federal Reserve was announced that they will take a pause on the high interest rates. Therefore, the reading for the market was low. Well, this is a good news. They are not keep rising interest rates, and therefore the pressure on the market should be lower. But there is a certain details that we should read between lines to understand why the market is falling 24 hours after that conference. I would like to highlight you a few notes I was taking during the conference to understand the reasons behind of this. First of all, he has been very clear. Jerome Powell has been very clear about the target of inflation is 2%. That's the target. In the past, in the last few months, we have been speculating that maybe at some point, if the inflation is getting persistent, if the inflation is getting chronic for the economy, maybe at some point they're going to consider that, well, an inflation of 3% is not a bad thing. Actually, we can accept that kind of inflation has a residual inflation, and that's not bad at all. But the thing is, he has been insistent, and also the Central Bank of Europe, Christine Lagarde, has been insisting that the target is to get an inflation in 2%. And here's the problem: they say that they probably estimate that inflation to 2% will be seen only by 2026. It means like if that's the target, an inflation of 2%, and that target is only reached by 2026, it means like we are so far from that goal, we are so far to reach that target, and therefore the monetary policies probably gonna keep being hawkish or hard with the financial credit and financial market. So there is 2 points basically that explain why we believe the situation is like it is right now. First of all, the US economy is still growing. The growth rate of US economy is, let me review with you exactly the numbers. It's like annually the growth rate of US is 2.10%. 2.10% of growth rate for United States. It means like the expectations we got then, it's the US economy is still strong, it's gonna keep growing. The unemployment rate is 3.8%, so below 4%. These two factors, the growth rate plus unemployment rate, a growth rate about 2% annually and an unemployment rate below 4% is giving us one single message: the US economy is still strong. Is resisting really well the monetary policies, and therefore there is no reasons to reduce the pressure in this sense. So reading between the lines, the obvious conclusion could be that there is no rush to ease the credit conditions, and B, interest rates will continue press markets. The pressure of the interest rates is gonna still there for a long time. Even actually, they were considering when we can start to face interest rate cut. And the estimations say that we're probably going to face the first interest. So the best or the most optimistic scenario is a cut on interest rates by the end of 2024, when they estimate the inflation going to be around 2.5%. And only then is when they're planning to reduce the interest rate from 4.5%, if they don't rise again before the end of the year, 4.5% to 4.1%. So they're telling us that by the end of the next year, the interest rate in best case scenario going to be around 5.1%, which is not too far where we are right now. And they also estimate that inflation going to be by the end of the next year, around 2.5%, which is, saying this is assuming that the inflation is going to get a kind of sticky, like they define the sticky inflation is 3.70% right now, but they believe that in best case, in 1 year and 2-3 months since now on, it's going to be in around 2.5%. Bad news. Why? Because if the expectation was like the expectation was well, maybe if the numbers are not good, maybe the inflation is coming back to a normal numbers, it's going back to numbers around 2%, then the Federal Reserve going to start to reduce the pressure on the credit conditions. They're going to start to release certain pressure, and the market's going to get more access to liquidity, or more flexible liquidity in that case. So analyze this, and I think this is the key point. We thought by the beginning of 2023 that by the end of this year, we will probably face a recession in US economy. That didn't happen. So no entering a recession, it's a good news. But because the expectation was to be in a recession by the end of this year, and it didn't happen, in that case, let's say investors have seen how the expectations to get more easy conditions from a monetary policies are gone right now, because there is no recession. There's actually what he defined like a soft landing, and we still don't know what he means by soft landing. He means by soft landing recession in the coming months, a soft recession in the coming months, or just simply slowing down on the growth economy. We don't know exactly what he means, because he didn't maticize, or he didn't specify what he means by this. So this will have put pressure in the Federal Reserve to a lower interest rate, but because that recession never happened, there is no pressure to reduce the interest rate by the Federal Reserve, and therefore it's bad news for those ones who were expecting easy conditions on the credit lines and more flexibility. Didn't happen, so it's bad news actually, and that's why the market is dropping. Since this has not happened, expectations of a dovish Fed have faded. That's my conclusion, that's my notes. Now it's time to take a look on the charts and decide what exactly is your view, your decision, your position in terms of the reaction of the market. First of all, last market report I did with ATFX, it was this chart. Let me put in full screen. It was this chart that is getting complete right now. It's getting complete. You see it's touching the neckline of this figure. It's a very bearish figure. It's a shoulder, head, shoulder. And if the figure is activated, if the neckline is broken, if it's broken, it's gonna project the price probably to the levels of 4,200, 4,150 points on a Standard & Poor's, the biggest equity index in the world. But it's not the first one. We have detected the same figure in Russell 2000, one of the index that represent in best conditions, more equal, more transparency in terms of small companies in US. And as you can see, that pattern has been activated hours ago in Russell 2000. So you can see how the Russell 2000 broke the neckline, and now is moving to the main target, which is probably going back to, we got it here, the projection. It's broken the first target, which was the first support area. It's gone. It's completely gone right now. And it's moving to the next, probably the next area to support this 1,725 points. And completing probably the target by 1,700 points. So it means like right now, since the Jerome Powell and Federal Reserve speech was gone, since they finish and they communicate his last words and predictions, and especially I believe is the reason why they put when they transmit to the public, to the investors, that they considering that inflation gonna be still 2.5% by the end of the year, and the interest rates in that case gonna reduce from now to 5.1%. It was actually a really bad output based on the expectation of the investors. They probably were expecting like more flexibility, interest reductions or cuts by the next 6 months. It didn't happen, so that's why I believe the market is dropping. In the other hand, what is strong, super strong, one more time, is the dollar index. Take a look. Is attacking the maximum of this year, done by the spring of 2023. Let me check what was the maximum. He was at 105.88 points index dollar, and right now we are in 105.56 with a maximum on this journey of 105.73.8. We are almost there. Dollar is keep pushing up There is a reason for this also. If we take a look also on treasury bonds, the 2 years US bond is quoting at 5.13%. And if you take a look on Europe, same bond, if we go to German bonds, 2 years German bonds are paying 3.27% of yield, while US is paying 5.13%. And therefore, look, even Italy is 4.5, Japan is paying 0.75, which means like the top economy, the biggest economy in the world is the one who is also paying better returns in the bonds, and also taking consideration that right now US is growing 2.10% annually rate, while Europe is giving an estimation of 0.10% of growth rate for this year. I mean, it's common sense. Rationally speaking, you're probably gonna move your money to dollars, to US bonds, because they paying better than Europe bonds, and the economy is growing faster than European economy. Therefore, it's more safe to keep your money there. I think that's the reason why dollar is rising and rising and rising. Equity is dropping, like we say. Equity is dropping. Russell 2000 is actually dramatically dropping, breaking out a very, very nasty figure. And we also can take a look on gold, because it's very interesting to see how the gold is adjusting this movement. As you can see, the gold is completing also the bearish trend, and is also completing the range. You see 1, 2, and 3 times we have been quoting the gold above $2,000 per ounce, and right now we are just moving lower and lower, because if the dollar is rising, I explained this relation many times, the correlation, inversal correlation between dollar and gold, reserves of the central banks around the world are basically in dollars or in gold. 20%, around 20% of the reserves of the world reserves in banks are in euros, and yes, the rest is just residual. So mainly currency reserve is dollars. Either you trust in the dollar, either you trust in gold. If your expectations is to face a weak dollar and very flexible conditions for Federal Reserve, the value of the dollar is dropping and the gold is rising. That's not the situation right now. We just mentioned a few points from the Federal Reserve and Jerome Powell's speech. The expectations is actually the opposite. Dollar is still strong and it's gonna keep strong for a while, and therefore gold is reacting, dropping in price. Clear? If we take a look also to European markets, we can also see that they basically struggle to support maintain certain supports. I'm talking about DAX 40, the biggest index in European market, and it's still trying to resist about 15,500 points. But in my eyes, in my opinion, you see the movement is getting weaker and weaker. The moving averages are clearly flattening, and the lateral movement is a clear indication of a weakness from a buy size. So probably the sellers are the ones who are putting more pressure in this market. And at some point, if these levels, if those levels here around 15,500 are lost, it's gonna initiate a full correction, going to 50% of the whole movement is moving to 14,500 points, and even the next movement, the next level from Fibonacci retracement, let's say, from the beginning of the year, the end of 2022 actually, to the maximums registered in the year, which was July 2023, 38% of that correction will take us to below 14,000 points on DAX. Which is a disaster. So yeah, let's keep an eye on these ones. I think I have given you good and clear review on the market, and especially I have been giving you I think a good interpretation of what is the reasons why the market are dropping after the words of Federal Reserve. Okay, hopefully you enjoyed this video. Please click on like if you like it, and leave me comments if you want I mention something in particular in the next market report. Bring me ideas, contact me, and I can make some research on different topics. Okay, you know I love macroeconomics mixed with the charts. That's the key to success investment strategies. So I'm gonna keep paying special attention to numbers plus charts. Okay, see you in the next videos, and thank you for watching. Take care. Bye.